Good afternoon.
Good afternoon, sir.
So today we are moving to the third topic. Third topic, the accounting analysis. Right. You can remember last few weeks we studied analysis of investing and analysis of financing activities. So today we are moving to the third topic. Third topic on the accounting analysis. Can you hear me now? Can you hear me now?
Yes, sir.
Right. So we have now third topic, analysis of operating activities. Right. So if you don't hear me, you have to tell me because there's a signal issue today. Right. So here we focus on statement of comprehensive income. We focus on the statement of comprehensive income. You can remember last two topics, we were focusing on statement of financial position. Statement of financial position. So we have analyzed whether assets, liabilities, and equity values are fairly presented in the statement of financial position. So this topic focuses on statement of comprehensive income. So we are mainly looking at income and expenses. So we are going to analyze income and expenses to see whether they have been fairly or appropriately presented in the financial statements. So we'll study first some theories relating to the income. Right. So the concept of income. So we'll simply study a theoretical part. Then we'll move on to the analysis. Income measures the results of companies' operating activities. Right. So income in the sense net income. Net income. Or you can say profit or loss. Profit or loss. So this measures the results of the company's operating activities. So it also shows the company's future earnings power. Company's future earnings power. Right. So more the income you have now, for example, more the income you have now, more will be your earnings power in the future. Because higher the profit, you can invest more profit for future operating activities. Higher the profit now, you can invest more for companies' future operating activities. Therefore, income is an estimate of companies' future earnings power. Estimate of companies' future earnings power. Theoretically, there are three types of income. Theoretically, you can see three types of income: accounting income, economic income, and permanent income. So we'll first have a brief idea. We'll first have a brief idea about each of these types. So let's see the accounting income. So this is the income you see in the financial statements. This is the net income or profit or loss you can see in the financial statements. So basically, this is measured by first revenue recognition, then you match expenses with the revenue. So you get the profit or loss. Right. You can remember, you know this, you are following the accrual basis. You are following the accrual basis or accrual concept when you are measuring the accounting income. But there are some issues with the accounting income. There can be windrow dressing situations. There can be instances of earnings management. And there could be accounting distortions. Accounting distortions, frauds, errors in the financial statements. Therefore, the net income or the accounting income as given in the financial statements is less useful for the analysis. That's why we are adjusting the financial statements. That's why we need accounting analysis before doing the financial analysis. So accounting income is less useful in your analysis. The meaning is you cannot take simply the income statement given to do the analysis. You cannot take the income expenses as given in the financial statements in your analysis. So you have to do some adjustments. Now you see, accounting income is less useful in the analysis. Right. Then the second concept, economic income. Economic income. Right. So this economic income shows the financial effects of all events and transactions in a comprehensive manner. So economic income takes into account financial effects of all events and transactions in a comprehensive manner. Right. It takes into account financial effects of all events and transactions of the company. Therefore, economic income measures company's net income in a comprehensive manner. In a comprehensive manner. Right. So that's what you can see now in your statement of comprehensive income. Right. So the statement of comprehensive income measures economic income. Statement of comprehensive income measures economic income. Right. You know, now financial statements, in the financial statement, you don't have just the statement of income. You have statement of comprehensive income. Statement of comprehensive income. Right. Now, if you see, for example, so let's see a financial statements. So let's see a example. Right. Now this is a financial statements of Richard Pearis for 2019. Now you see in 2019, your statement of income ended up with profit or loss. You see, the last item in your statement of income is profit or loss for the period. But later on, the format change, the structure change. You know, after profit or loss, you have other comprehensive income. Other comprehensive income. Right. So in your statement of income, so you start with the revenue, deduct cost of sales. Then you have gross profit. Then administrative, distribution expenses, other expenses, finance cost. So all deducted. Then you have profit before tax. Profit before tax. Then income tax. Income tax. Then profit for the period. Profit for the period. Profit for the period. So earlier, the last item in your statement of income is profit for the period. So this is statement of income. Statement of income. So earlier we call accounting income this profit for the period. Right. But now you know the structure change. After the profit for the period, you add other comprehensive items. Other comprehensive items. other comprehensive income. For example, changes in fair value of property, plant and equipment, changes in fair value of financial assets. So other comprehensive income items are added. Then you have comprehensive income. You have comprehensive income. Right. So this comprehensive income we call economic income. Economic income. Right. So your statement of comprehensive income shows economic income. Economic income. So it considers financial effects of all events and transactions in a comprehensive manner. Right. So this total comprehensive income, so you can say economic income. Economic income. Right. So in the economic income, you see financial effects of all events and transactions you have taken into the calculation. Right. Now, if you see the financial statement, this total comprehensive income, you can say company's economic income. Company's economic income. Right. Now, in today's context, the accounting income is total comprehensive income. But earlier, this profit for the period is the accounting. Now, accounting income is this total comprehensive income. And it's same as the company's economic income. Company's economic income. Right. Now, it's very important you have to remember this. This total comprehensive income, or in other words, economic income, includes recurring and non-recurring items. You know, recurring items are the items of income expenses that you can normally see every time. That you can normally see every time in financial statements. So these recurring items are repeatedly, you can see in the statement of income. Then the other items you can say non-recurring items. So your economic income includes both these recurring and non-recurring items. So in your analysis, you have to separate these non-recurring items, right? So we'll see with examples. So you have to find out what non-recurring items are included here. So you have to separate them when you are doing the accounting analysis. Right. So later we'll study this. How we are going to separate non-recurring items. So conceptually, you see, economic income includes both recurring and non-recurring items. Now, your financial statement shows economic income, right? You see in your financial statement, in your statement of comprehensive income, you see total comprehensive income. Now you see financial statements now reflect economic income. So this economic income includes both recurring items and non-recurring items. Both recurring items and non-recurring items. When you are analyzing, so these non-recurring items, you have to separate. So we'll be discussing this with examples. Right. So I have uploaded a tutorial. So today we are going to do the tutorial. So with this tutorial, we'll learn how to separate non-recurring items in your analysis. Right. So we'll be learning this later. Now we have learned the concept of economic income. Right. Now this is important. You know, economic income includes both recurring and non-recurring items. Therefore, it is less useful when you are doing forecasting. Because when you are doing forecasting, we need only the recurring items. You can forecast only the recurring items. So recurring means the items of income expenses that you can usually see every time in the statement of comprehensive income. So we call it a recurring item. So that you can see repeatedly in the statement of comprehensive income. So we call them recurring income or recurring items of income expenses. So when you are forecasting, so we can forecast only recurring items of income expenses. We can forecast only recurring items of income and expenses. But economic income includes both recurring and non-recurring items. Therefore, it's less useful for your forecasting. Now, if your objective is to prepare forecast financial statements, you don't take economic income. Because economic income includes these non-recurring items. Therefore, you cannot do forecasting. But if the analysis objective is to analyze shareholders' return, ROE, you can remember we discussed ROE analysis. So if the analysis objective is to analyze ROE, then you have to take economic income. So remember, in the ROE analysis, you should take the economic income. But if you are doing forecasting, so you shouldn't take the economic income. Because economic income includes non-recurring items. Economic income includes non-recurring items. Right. So this is very important in your assignment. Right. So I'll explain how to apply these in your assignment. So when you are doing the tutorial, you can understand. Right. So remember, these are the learning points. So economic income measures companies' all financial events and transactions in a comprehensive manner. Economic income measures financial effects of companies' own event, companies' all events and transactions in a comprehensive manner. Therefore, it includes both recurring and non-recurring items. Therefore, it is less useful in forecasting. It is less useful in forecasting. But if your objective is to analyze the ROE, so you should take economic income. Now you see, depending on the analysis objective, you should select which type of income you have to analyze. You see, depending on the analysis objective, you should decide which type of income you should take into your analysis. So these are your learning points. Right. Then we'll see the third concept, permanent income. Right. So there are some other alternative terms. For example, sustainable income. Sustainable income. Or you can say sustainable earning power. Right. So simply this is the recurring part of your income. So this is the recurring part. The recurring part of the income we call permanent income. Recurring part of the income we call permanent income. Right. Now you can see the differences between these three concepts. Right. So if you see again this statement of income, right. Now we have total comprehensive income. So this is the company's statement of comprehensive income. Statement of comprehensive income. So this is company's statement of comprehensive income. So you can see this statement of comprehensive income, total comprehensive income. So this total comprehensive income is economic income. Now this is also accounting income. So this is also accounting income. Right. Earlier accounting income was profit for the period. So you can see the economic income in your financial statements. Right. So this economic income includes, we studied, economic income includes both recurring and non-recurring items of income and expenses. So this economic income includes both recurring and non-recurring items of income and expenses. So this recurring part of income, we call permanent income. This recurring part of income we call permanent income. Right. Now you can understand with this diagram, you can understand the three concepts of income. Now, what are the three concepts? Account income, economic income, and permanent income. So these are the three concepts: accounting income, economic income, and permanent income. Right. So I will highlight in yellow. Then you can easily see these three concepts: accounting income, economic income, and permanent income. Now, if you see the statement of comprehensive income, you see the accounting income is the economic income. So that includes both recurring and non-recurring items. So this recurring part of income, we call permanent income. So this recurring part of income, we call permanent income. Right. So this is what's useful in your forecasting. When you are doing forecasting, you should see or you should take companies' recurring income. So you can use recurring income for your forecast. But if you are analyzing the company's ROE, you should look at the company's total comprehensive income. Total comprehensive income. Right. So I guess it's clear now. Any questions? Now you see the difference between economic income and permanent income is these non-recurring items. The difference between economic income and permanent income is these non-recurring items. These non-recurring items. Now we'll see some examples of non-recurring items. Right. So we'll see some examples of non-recurring items. And we'll study how we are going to consider these in your analysis. Right. So this is very important. Right. You know, so with your previous sessions, now you have learned doing just analysis for the given financial statement is not that useful. So you should see first financial statement items are at appropriate values before starting the analysis. So if the financial statements are not, items are not appropriate values, then you have to do some adjustments before doing your financial analysis. Right. So similarly, this is very important. So you have to select the appropriate income type depending on the analysis objective. We have studied if the analysis objective is to analyze ROE, you should look at the economic income. But if you are going to do the forecasting, you should look at permanent income. Now, you know the difference between economic income and permanent income is these type of non-recurring items. Right. So these are very popular non-recurring items. Changes in fair value of property, plant and equipment. You can write down, and financial assets. Financial assets. Extraordinary items. Discontinued operations. Accounting changes. So these items you don't see usually every time in the financial statements. Therefore, we call them non-recurring items. Non-recurring items. So we'll learn now how we are going to adjust these types of non-recurring items in your financial statements. Right. Now let's see changes in fair value of property, plant and equipment, financial assets. Right. So, you know, by studying the accounting standards, some fair value changes are taken to the statement of income. Sometimes fair value changes are taken to the statement of comprehensive income, other comprehensive items. Now, you know, your statement of comprehensive income consists two sections: statements of income and statement of other comprehensive items, other comprehensive income. Sometimes fair value changes are taken to the statement of income. Meaning is it's taken to the statement of income as a part of profit for the period. There are situations fair value changes go to other comprehensive income. Now I'll take simple example. Now let's say financial year 2000, financial year ending 31st March 2021. Now let's say at the beginning of the financial year, there was a revaluation reserve. Let's say this is relating to motor vehicle. Let's say 10,000. This is at the beginning of the financial year. Let's say during the year, this motor vehicle again revalued. During the year, this motor vehicle again revalued. As a result, there was a gain, revaluation gain of 5,000. Revaluation gain of 5,000. Then how we are going to account this revaluation gain? Now earlier at the beginning, there was a revaluation reserve of 10,000 for this motor vehicle. Therefore, this gain, motor vehicle debit, reserve credit. So this gain goes to the other comprehensive income. revaluation gain. So this 5,000 gain goes to the other comprehensive income. Other comprehensive income. Now let's say another example. Now these things you should know by now, because you have studied the accounting standards. So this is according to case 16. Now let's say another example. Let's say 1st January, 1st April, there was no revaluation reserve. So when the motor vehicle revalued last time, there was a loss. So motor vehicle last revaluation, sorry. With the motor vehicle last revaluation, let's say there was a loss. Revaluation loss. Let's say 10,000. Let's say 8,000. Therefore, that has gone to the profit and loss. Let's say according to the last revaluation, revaluation loss has taken to the profit and loss. Let's say during the year, motor vehicle again revalued. As a result, let's say there was a gain of 5,000. Now, how we are going to account this gain? You see, last revaluation, there was a loss. You have taken to the profit and loss. So this gain has to be set off to that, or this gain has to go to profit and loss. Because last revaluation, you see, there was a loss. So you have taken that to profit and loss. Now this is reversal of the previous revaluation loss. Therefore, this should go to the profit and loss. Now you see this 5,000 now goes to profit and loss part, statement of income. Now you see fair value changes sometimes in statement of income part. There are situations fair value changes are in the statement of comprehensive income. Statement of comprehensive income. Right. So let's see another example. Let's think about financial assets. Now let's say company. Another example. Company has bought some bonds, debentures. Let's say company has invested in some debentures. Let's say objective of this investment is to sell these debentures. Then this has to be recorded. So if the objective is to sell the debentures, so this has to be recorded in the financial statement at fair value. Any changes in fair value, has to go to other comprehensive income. Other comprehensive income. So if you have studied IFRS 9, so I have asked last time to study IFRS 9. So you should have studied now. So if the objective is to sell these debentures, So you have invested. Now the objective is to sell. Then this has to be valued at fair value. Any changes in fair value, you have to take to other comprehensive income. Now the example, let's say you have invested in shares. Let's say you have invested in shares. Let's say objective of this investment is to invest for a long term. Keep the investment. Let's say our investment objective is to keep the investment for a long time period. Then this has to be recorded at fair value. Fair value. Any changes in fair value, you have to take to other comprehensive income. But if you have invested in shares for trading purpose, if you have invested in shares for trading purpose, again, this has to be recorded at fair value. But any changes in fair value, you have to take to the profit and loss. Profit and loss. Now you see, some fair value changes you can see in the other comprehensive income, and some fair value changes you can see in the profit and loss part. Profit and loss part. Right. So you have to identify these types of fair value changes, because these are non-recurring items. So you have to study the income or profit and loss part and other comprehensive income part to identify these fair value changes. Right. So you should take these as non-recurring items. Non-recurring items. So when you are doing your assignment, you have to study the financial statements. I identify these kinds of fair value changes taken to the profit and loss and other comprehensive income, because these are kinds of non-recurring items. Non-recurring items. Right. Any questions? Any questions? Right. Then extraordinary items. Extraordinary items. We'll see the second point. Extraordinary items. So this is the meaning of, simple meaning of extraordinary items. So extraordinary items are unusual in nature. Unusual in nature. So here unusual means they are not related to the ongoing business operations. They are not related to the ongoing business operations. They are not related to the company's normal business operations. And the frequency of occurrence is less, very less. So you don't expect that these kind of extraordinary items will repeat in the future. So you don't normally expect these kind of extraordinary items will repeat in the future. So if you find any items in your income statement, unusual and infrequent in occurrence, so you can say that's extraordinary item. Extraordinary item. I will study some examples. Now let's think about manufacturing company. Let's think about manufacturing company. So how about this write-off trade debtors, bad debts? Is that extraordinary? Bad debts. You will have bad debts when you are selling goods on credit. You see, you will have bad debts when you are selling goods on credit. Now you see, bad debts are related to the day-to-day operations. So selling goods on credit is part of your day-to-day operations. Selling goods on credit is part of your day-to-day operations. So because of that, you will have bad debts. Now you see, bad debts are related to the day-to-day operations. Can you say unusual? Can you say unusual? No. Therefore, this is not extraordinary item. This is not extraordinary item. This is not an extraordinary item. How about second one? Damage to inventory when unloading and carrying to the warehouse. So what do you think? Is that extraordinary or not? So damage to inventory and when unloading and carrying to the warehouse. Is that extraordinary? So you are running a manufacturing business. So when the supplier sent you inventory, so you have to unload and bring to the warehouse. Now you see, this is part of your day-to-day operations. Unloading inventory and taking to the warehouse is part of your day-to-day operations. Therefore, this is related to your day-to-day operations. This is related to your day-to-day operations. Therefore, this is not an extraordinary item. So likewise, you should be able to identify which items are extraordinary. You should be able to identify which items of these are extraordinary. So what do you think, number three? Number three, gain or loss from sale of property, plant and equipment. Gain or loss from sale of property, plant and equipment. Is that extraordinary? Is that extraordinary? So you will have this kind of gain losses when the asset useful life is over. You know, when the asset useful life is over, you have to replace the asset. So you have to replace the asset. So this is part of your operations. When the useful life is over, you should replace the asset. So this is part of your operations, day-to-day operations. Therefore, the gain or loss from sale of all property, plant and equipment, not an extraordinary item. So how about number 4? Number 4, financial effects of employee strikes. So what do you think? Number 4, financial effects of employee strikes. Is that extraordinary? Is that extraordinary? Financial effects of employee strikes. Employee strikes, is that part of your day-to-day operations? This is not part of your day-to-day operations. Now you see, this is unusual. This is unusual. Do you expect that this will be repeated in the future? Usually not. Therefore, occurrence is infrequent. Occurrence is infrequent. So you can see this is extraordinary. Extraordinary. How about number 5? Loss of inventory from fire. Loss of inventory from fire. So this is also unusual. And you don't expect this will repeat in the future. So usually you don't expect that there will be a fire in the future. So therefore, this is extraordinary. How about number 6? Warranty claim on damaged product. So giving warranty is part of your company's day-to-day operations. So there will be warranty claims if the company provides warranty. So this is part of your day-to-day operations. Right. Therefore, this is not unusual. Therefore, this is not extraordinary. Right. So likewise, so you should be able to find out which items of your income expenses are extraordinary. You know, extraordinary items are kinds of non-recurring items. Because you don't expect such extraordinary items in the future. So by studying the financial statement, so you have to apply the same in your assignment. By studying the financial statement, you should see any extraordinary items in your financial statements. So if you find any extraordinary item, then you can say this is non-recurring item. So by studying your financial statement, particularly statement of comprehensive income, you should find out non-recurring items. You should find out extraordinary items. So you have to study the entire statement of comprehensive income. Because you can't separately see in the statement of comprehensive income extraordinary items. There is no separate line items for extraordinary items. So you have to study the entire statement of income and find out which items of your income expenses are extraordinary. So if there is any item of income expenses that is not related to the day-to-day operations, and if the frequency of occurrence is infrequent, if the frequency of occurrence is very less, then you can say that item is extraordinary. That item is extraordinary. So you have to separately identify extraordinary items. Now we'll practice this with this example. So while doing these examples, you will get to know. You will get to know about these, right? So we'll see this example, right? So you study this example. You have additional information in the next slide, right? So study the example, right? So give me 1 minute. You can study in our example. Right. So you have statement of income. You have statement of income. Now you see statement of income ended up with net profit for the year or net income for the year. Then you have additional information. Additional information. You see other operating expenses comprise of the following. How much other operating expenses? 100. You see in the statement of income. In the statement of income, other operating expenses 100. Now you see this includes these items. This 100 includes these items. So loss of inventory from fire. So this is extraordinary. Extraordinary. Loss on sale of property, plant and equipment, this is not extraordinary. Warranty claims on damaged product, this is not extraordinary. Giving warranty for products is part of your company's day-to-day operations. Damages pays to supplier for delay in supplying goods because of employee strikes. Now you see, your company has to pay some damages to a customer because there was an employee strike. Because of that, your company was unable to supply products on time. You are unable to supply products on time. Then you had to pay damages. So this is also extraordinary. Extraordinary. Now you see, your other income consists of two extraordinary items. Loss from fire 60 and damages paid to customer 15. So out of 100, 75 is extraordinary. Out of 100, 75 is extraordinary. So this is non-recurring. Extraordinary items are non-recurring items. Right. So in your analysis, you should separate these non-recurring items. So you should separate these non-recurring items. Right. Now let's prepare the statement of income. Let's prepare the statement of income. Right. So you have sales 900, cost of sales 600, gross profit 300. Then under operating expenses, depreciation 50, bad debts 50, interest on loan 25, but other expenses not 100. You see, you found out of 100, 75 is extraordinary. Then only 25, the recurring part is only 25. Right. 75 is non-recurring, extraordinary. So recurring part is only 25. Only 25. Right. So once you deduct all the recurring items, all the recurring income expenses from gross profit, so you have recurring income or recurring profit. Recurring income or recurring profit. So how much recurring profit? 300 minus these recurring items, 150. Then you take non-recurring items. Non-recurring items. Non-recurring items. So what are the non-recurring items? we have two non-recurring items. Inventory loss from fire and damages paid to customer 15. Inventory loss, 60. Damages paid, 15. So these two are non-recurring. Then your profit for the year, profit for the year, 75. You see, profit for the year same as in the given financial statements. You see, profit for the year in the given financial statement 75. So here also 75. Now you see, we have separated, or we have separately identified non-recurring items. Then you can see in your statement of income, recurring profit. So in the recurring profit calculation, you take only the recurring items. Sales, cost of sales, these operating expenses are recurring items. So you expect these items will be repeated in the future. So every year you have sales, then cost of sales, depreciation, bad debts, interest on loan. So these are recurring items. So you have recurring profit. Recurring profit. So this is your permanent income. This is your permanent income. Recurring profit is your permanent income. You can remember, when you are calculating permanent income, you can take only recurring items. Right. So your permanent income is 150. So this company's permanent income is 150. So when you're forecasting, so you should take only the recurring profit. So when you are forecasting, you should forecast only these recurring items. You should forecast only these recurring items. In addition, when you compare financial statement over number of years, now this is very important in your assignment. Because in your assignment, you compare financial statements of 5 years. So you should compare only the recurring items. In other words, you should take only the recurring profit when you are doing the comparison. You should take only the recurring profit. For example, when you calculate net profit margin, so which profit you take? Now let's say you compare this year net profit margin with the last year. So how do you calculate the net profit margin? Net profit divided by sales. So in the given financial statement, our net profit is 75. But here we have identified the recurring net profit 150 and the end net profit is 75. So when you compare net profit margin with the last year, so which net profit would you take to calculation? 150 or 75? 150 or 75. So remember, when you do comparisons, you should take only the recurring profit. You should take only the recurring profit. Right. So this is year 2020. Let's say year 2020. You compare with last year. Let's say you compare net profit margin. To compare net profit margin. So for the year 2020, net profit margin, you take 150 divided by sales 900. So how much percentage? You can multiply by 100. Then how much percentage? 150 divided by 900. So 2020 net profit margin 16.7. 16.7%. So you can compare this with the last year. You see last year net profit margin 10%. You see last year net profit margin 10%. So remember, when you are doing comparisons, you should take only recurring profit. This is very important in your assignment. Because in your assignment, you compare financial statements of number of years. You compare financial statements of 5 years. So in your ratios calculations, you should take recurring profit. You should take recurring profit. So that's why we are going to separate these non-recurring items. So we separate non-recurring items because we need to find out recurring profit. Now you can understand the purpose of separating non-recurring items. So once you separate non-recurring items, you can see recurring profit. You should use that recurring profit when you are doing comparisons. When you are doing comparisons. This is very important in your assignment. So I'm going to check this in your assignment. If not, you will be losing marks. You know your assignment submission is on 13th week. You had 13 weeks for your assignment. Then you can't have any excuses. At the end, I expect very perfect assignment. Because you have 13 weeks. You had 13 weeks. Right. So with your assignment, I can understand who have attended 4 lectures and who have not. I can understand who have followed my guidelines. So those who have followed my guideline will surely be attended 4 lectures. So if these are missing, then I know those who have not these kind of, or who have not done these kind of adjustments. So I know they have not attended 4 lectures. So remember, at the exam, I'm just worried about only those who have attended 4 lectures. Right. So from your assignments, I can easily find out. I can easily find out. So if you haven't done these kind of adjustments, then you will be losing marks. You'll be losing marks. Right. Now you can understand the purpose of separating non-recurring items. Because once you separate non-recurring items, you can calculate recurring profits. So this recurring profit is important when you are doing comparisons. In addition to forecasting, when you are doing comparisons over years, so what's important is this recurring profit. Right. Now we have studied two types of recurring items: changes in fair value and extraordinary items. Extraordinary items. So let's see one more: discontinued operations. Right. So you should have studied this. SLFRS 5, SLFRS 5. So if you haven't studied this standard SLFRS 5, so you should study now. Right. So every time I'm saying, if you don't know accounting standards, then you don't have any value in the industry. Right. You have nothing in the industry. So during the industrial training period, you should update your standards, because within the next few months, there will be some more changes to the accounting standards. So you will have this chance only if you have gone for audit training. So if you work for somewhere else, you don't get any opportunity to update the accounting standard. So that's why our department motivates you to go for audit training. Right. Then by the end of the training, you have a very good knowledge about accounting standards, especially, and auditing standards. Right. Then you have a good value in the industry. With your degree title, you have a better chance of getting a good job, employment opportunity. Right. So remember, now, if you haven't studied some standard, you should study before the training period. Because with the training, you don't have any time. You don't have much time to study standards for the first time. So during this time period, if you haven't studied any standard, if you haven't studied any accounting standard, so this is the last chance you have. While you do the industrial training in an audit firm, you can update with your practical knowledge all the accounting standards, almost all the accounting standards. Right. So after the training, you have a knowledge about accounting standard with practical aspects. You have a practical knowledge of accounting standards. So that's what industry values. Right. So industry values the practical knowledge of accounting standards. Right. So during this time period before the industrial training, so you should read all the standards and have some, or have a knowledge to a certain extent. Then with your industrial training, you get the practical knowledge of the accounting standard. Then you will very suit to the industry or employment opportunities. Right. So that's what the plan you should have during the industrial training. So this is about SLFRS 5. Right, discontinued operations. So simply it is disposal of major line of business. For example, let's say your company provides 3 products. Let's say your company manufactures and sells 3 products, ABC. Let's say due to decline in the demand, you stop producing A. So you have discontinued product A. You can say discontinued operation. Discontinued operation. There are situations you see, you stop doing business in a major geographical area. Let's say over the last few years, you are operating in Australia. So with the corona impact, you stop your business in Australia. Then you can say this is discontinued operations. Discontinued operations. Right. So you should read this SLFRS 5. Right. So when you are preparing financial statements, when you're preparing the statement of comprehensive income, you should separately show profit or loss from discontinued operations. So according to SLFRS 5, there should be a separate line item in your statement of comprehensive income for the profit or loss from discontinued operations. So I'll show one example. If you see these financial statements, you see there's a separate line item, profit or loss from discontinued operations. You see? So this company had discontinued operations. This company had discontinued operations. So in the statement of comprehensive income, you see there's a separate item, line item for this loss from discontinued operations. Now how much loss? 15,000. So on the face of the statement of comprehensive income, there should be a separate line item. So we should name it profit or loss from discontinued operations. Then items before this, you should consider as continuing operations. The items before this, you should consider as continuing operations. Continuing operations. Now you see profit from continuing operations, then you take discontinued operations. Then you have profit for the period. Profit for the period. You see, profit from continuing operations, then loss from discontinued operations, then you have profit for the period. Right. So we'll practice this with an example. We'll practice with example. You see example 3. Example 3. Now you study this exam. Study this exam. You see during the year 2019, A Limited ceased to use a manufacturing plant. So this company stopped using a manufacturing plant because the demand for that product has declined. Now you see this company stopped producing a product. So this company stopped producing a product. So this company stopped producing one of its products. So you can say that is discontinued operation. So at that time, net book value of the plant was 1,125. Net book value in BV, net book value. But it sold for 1,190. So that plant sold because that plant is no more use. That plant has no more use. So company has sold the plant. So at the time of sale, net book value 1,125. It sold for 1,190. It sold for 1,190. You see, there's a profit. There's a profit from sale. Profit from sale. How much? Profit from sale? 65. Profit from sale, 65. You see, in relation to the discontinued operations, discontinued product, sales 2,150. Cost of sales 1,200, administrative expenses, distribution cost, and you have finance cost. Now you have to show how these discontinued operations are presented in the financial statements. Now you see your total sales 11,250. You see company's total sales 11,250. Out of that, 2,150 is sales for that discontinued product. Similarly, cost of sales 8,130. That includes cost of sales of the discontinued product 1,200. Right. So your income statement shows the total values. So these values include the values relating to the discontinued product. Now you have to separate these values. You have to separate these from the total values. Right. So we'll have a working. We'll have a working. Right. So we'll take first total values in rupees thousands. We'll take first total values. right? So we'll take total values, sales. So we have total values in rupees. In rupees, sales 11,250. Cost of sales 8,130. You have gross profit 3,120. Administrative expenses 650. Distribution cost 765. Other expenses 110. Finance cost 125. You have profit before tax 1,470. Income tax 441. Then you have profit for the year. Profit for the year 1,029. So these are total values. Total values. So you should separate from these total values related to the discontinued operations. Discontinued operations. So what are the values related to discontinued operations? You see the example. Sales 2,150. You see, cost of sales 1,200. Then for the discontinued product, gross profit 950. Then administrative expenses 200. Distribution expenses 130. Finance cost 90. There are no other expenses. Finance cost 90. In addition, there's a gain on sale of property, plant and equipment. We calculated profit on sale of property, plant and equipment. We calculated. You see net book value 1,125. The assets sold for 1,190. So profit on disposal 65. Then how much profit before tax relating to discontinued operations? How much profit before tax relating to discontinued operations? Profit before tax. $595. Then you have tax rate. You have tax rate. How much? Tax rate 30%. Then 30% of this is income tax. 30% of this is income tax. 179. Then profit for the year 460. 460. Now you separate these items from the total values. You have values related to the continuing operations. You have values related to the continuing operations. So deduct these from total values. You deduct these from total values. Then you get values relating to the continuing operations. 11,000 sales, you see sales, 11,250 divided by 2,150, 9,100. Cost of sales, 8,130 minus 1,200, 6,930. Then gross profit, 2,170. Then administrative expenses. Let's say this profit on sale is included in the administrative expenses. Then how much administrative expenses relating to the continuing operations? Let's say this 65 profit already included here. 65 profit already included here. Then administrative expenses relating to continuing operations, 515. 515. Distribution cost, 635. Other expenses, 110. Finance cost, 35. Then profit before tax, 875. 875. Income tax. Income tax total 1,441 minus income tax related to the discontinued operations 179. 441 minus 179, 262. Then profit for the year, 630. 630. Now you can prepare the statement of income. This is simply a working. You can prepare the statement of income. So let's prepare our statement of income. Statement of income. So you have to take first continuing operations. You have to take first continuing operations. Sales, cost of sales, gross profit, administrative expenses, distribution expenses, other expenses, finance cost, all relating to the continuing operations. Right. So we have calculated continuing operations. Sales 9,100. Sorry. Cost of sales 6,930. 6,930. Gross profit relating to continuing operations 2,170. Administrative expenses relating to continuing operations 515. Distribution expenses 635. Other expenses 110. Finance cost 35. Finance cost 35. Then you have profit before tax. Profit before tax 875. Deduct income tax. Income tax 262. Then you have profit for the period from continuing operations. Profit for the period from continuing operations. How much? 630. 630. Right. So under continuing operations, the last item is profit for the period from continuing operations. Then you have to take discontinued operations. You have to take discontinued operations. So under discontinued operations, you have to take only this profit after tax value. You have to take this profit after tax value. So let's see that example, annual report example. You see this annual report example. First, you see continuing operations. You see continuing operations. Then profit for the period from continuing operations. Then you have discontinued operations. Discontinued operations. Discontinued operations. So under this, you have to show profit or loss after tax from discontinued operations. Then you get profit for the period. So under discontinued operations, you have to show profit or loss after tax. Profit or loss after tax from discontinued operations. So how much profit or loss after tax? 416. So we have profit after tax from discontinued operations, 416. You see 416. Then you have profit for the period. Profit for the year. 613 plus 416. 10,029. Profit for the year, 10,029. Now you see in your financial statements, you can separately find if there's any discontinued operations. You can separately find if there's any discontinued operations. So this is non-recurring. This is a non-recurring item. This is your recurring profit. This is your recurring profit. Right. So this is non-recurring item. So your recurring profit is 613. Your recurring profit is 630. So when you compare with previous years, you should use this recurring profit. When you compare financial statement with previous years, you should use this recurring profit. This profit from discontinued operation is non-recurring item. Non-recurring item. Right. So if there's any discontinued operation, you can separately find from the financial statement. Right. So any questions? Any questions? Right. Now let's see tutorial 5. Let's see tutorial 5. You see a financial statement same as last tutorial. Financial statements are same as last tutorial. But adjustments are different. You see a different sets of adjustments, additional information. Right. Now you see the additional information. Have a quick look. So number one, we did last time. Additional information number 1, we studied last time. So company had guaranteed import loans of another company. So that company was unable to pay the import loan, therefore our company was liable. You can remember we made a provision. We made a provision in the account. We made a provision in the account. So this is a non-recurring item. Because guaranteeing other company's import loan is not our business. So this is non-recurring item. So that non-recurring item you have to separately identify in the financial statement. Then you see number 2, a fire occurred in one of the company's showrooms. As a result, there was a loss of 135,000. This has been included in the distribution expenses. Now this is extraordinary. Therefore, this is non-recurring. This is non-recurring. Then number 3, you see company changed the depreciation calculation method from reducing balance method to straight line basis. Now you see last 2 years, company was following reducing balance method. We studied that last time with tutorial number 4. Last 2 years, company was following reducing balance method. But this year, company changed to straight line basis. Now you see last 2 years financial statements on reducing balance method. This year, company prepare financial statements on straight line basis. So this year depreciation is on straight line basis. The amount of the depreciation that would have been decreased if the new method were applied for the 2019 and 20 years, 191 and 198 in thousands. So if the new method applied for the last 2 years, the depreciation would have decreased by these amounts. You see, if the new method applied for the last 2 years, the company's depreciation would be decreased by these 2 amounts. Now let's see the adjustments. Then number 4 about discontinued operations. You see, during the year 2021, company ceased to manufacture. Company stopped manufacturing and selling one of its products because the demand for the product has declined. You see, in relation to the discontinued product, you have sales, cost of sales, administrative expenses values for the year 2021. Right. Then you see assets and liabilities of the discontinued operations in respect of the previous 2 years. Now you have to read very carefully this. You stop producing the product during the year. So you stop producing this product during the year. Now these are assets, liabilities, income, expenses of the discontinued operation over the last 2 years. So let's see the adjustments. So we learn this point. Right. Now, similar to the last tutorial, you have to make necessary adjustments to the financial statement. Similar to the last tutorial, you have to do necessary adjustments to the financial statements. Right. So today I'll give a guide. Then you try to work out this tutorial. So next time, we'll see your answers. Right. Now what we are doing is, right. So I have uploaded in your LMS for this tutorial worksheet. So you can do all the adjustments in that worksheet. You can download that worksheet. So let's see now. That tutorial 5 worksheet. Right. Now you see in one sheet financial statements. The other sheet is adjustment for financial statements. Right. Now similar to the last tutorial, so for each year, we have one column before adjustment, another column for adjustment, and the third column for adjusted value. So we have this for all 3 years, 2021, 2020, and 2019. Right. Now first you take the line items. Line items with the values. Right. So you can copy these line items first. You can copy these line items first and paste here. You paste here. Right. So these are the line items in the given financial statements. But you know now we learn, we should know the recurring income. We should separate non-recurring items. We should separate non-recurring items. Then your financial statement should present the recurring profit, then non-recurring items. Right. Now you see the statement of income, sales, cost of sales, gross profit, interest received, administrative expenses, distribution cost, finance cost, profit before tax, income tax, profit for the period. Right. We can say a recurring profit. Recurring profit. Recurring profit for the period. Right. So we should find out recurring profit for the period. Then after the recurring profit, you should take non-recurring items. So insert some rows. You can write down non-recurring items. Non-recurring items. Right. So by studying those additional information, so you should find out non-recurring items. You should find out these non-recurring items. So you can insert some rows here. So after getting non-recurring items, you have profit for the year. Profit for the year. Right. So after getting non-recurring items, you have profit for the year. Right. So when you are doing comparison over these 3 years, so you'll have to use this recurring profit. You'll have to use this recurring profit. Right. Now let's take the amounts. Sales, you can link 2021 before adjusted column, before adjustment column, you take the given values. Sales, cost of sales. So you can link and take the value. The procedure is very similar to last time. The given values you take from the financial statements. So here values before adjustment. You simply take from the given financial statement. So equal, you link the given value. Then you can drag. You can drag to copy to the rest of the sales. Then profit for the period, or profit for the year, $1,690. 1,690. Right. So it's same as the given profit. So we don't have here recurring profit. We should find out in the adjusted column. The recurring profit we should find out here in the adjusted column. This recurring profit you have to find out in the adjustment column, adjusted value column. This recurring profit you have to find out here. You have to find out here. That the profit for the year 1,690. Similarly, for 2020, you take the given values. Equal, you link to the relevant sales. Now we got the sales. We got the sales value 2020. Then you can drag and copy to the rest of the sales. Then profit for the year, profit for the year. $1,455. $1,455. Right. So this recurring profit you have to find out in the adjusted column. You have to find out in the adjusted column. Right. Now let's change the color here. So we'll use this color. Right. So recurring profit, you have to find out in the adjusted column. So similarly for 2019, in the before adjusted column, before adjustment column, you take the given values. You take the given values. Then profit for the year. $2,066. Profit for the year 2066. So this recurring profit you have to find in the adjusted column. So you have to do the necessary adjustments and find this recurring profit. Right. Now you have to study all the additional information, do necessary adjustments, and find this recurring profit. So what you have to do is you separate non-recurring items. By studying additional information, you separate non-recurring items. Then you can find out recurring profit. You can find out recurring profit. So from the profit for the year, you separate non-recurring items. Then you can find out recurring profit. Right. Similarly, you take the given values here in your statement of financial position. You take the given values in the statement of financial position. You take the given values here. Right. Then for 2020, again you take the given values in the before adjustment column. Then for 2019, you take the given values. We'll see whether any adjustments to these assets and liabilities. We'll see if there's any adjustment to these assets and liabilities. Right. So when you come next time, you should calculate here adjusted in the adjusted column recurring profit. So when you're coming next time, you should come up with all these 3 years in the adjusted column the recurring profit. Now it's very simple. You study the additional information and find out non-recurring items. Then you deduct those non-recurring items, remove from your given values. Then you can find out recurring income expenses. By using recurring income expenses, you can calculate recurring profit for the year. Right. So when you're coming next time, you complete this worksheet up to this point. The rest I will discuss. We'll have a discussion. Right. So you complete this worksheet up to this point. You study the additional information and find out any non-recurring items. Then remove those values from the given value. Then you can find the recurring income expenses. From the recurring income expenses, you can find out recurring profit. Right. So that's what you have to do. So complete up to this point and you come up with your answer. Then we'll quickly do this, complete this tutorial. Right. Any questions? Right. Then we'll meet next time.
Thank you, sir. Thank you.
Thank you, sir.
Thank you, sir. Thank you, sir.